All right, the stock market continues to be really quiet. Last 2 days, about as small a range as you could possibly have. Pretty equal in terms of the size of the ranges. Really not a whole lot moving the markets, even with jolts coming out, employment report coming out later this week. That's going to create a little bit of volatility, at least some excuse maybe for some volatility as we head into next week. We'll talk about the technical setup, at least what I expect will happen late this week, early next week, based off of what the technical, what the charts are looking like, what we can anticipate, whether we'll continue to be really bullish, like break out to the upside, or whether we'll start to give back some of these gains. Not a lot, right? I don't expect a big give back, but maybe a little bit of a more of a near-term decline here next week. So we'll break all that down as we always do in our charts. Take a look at what's going on. We'll take a look at what's driving the action. An interesting move today in commodity prices, a big rebound today, and a little bit of a rebound in yields too. We'll talk about that. That's got a little bit of an inflationary component to it. The dollar remember the dollar rebounded yesterday. It did not continue that rebound, so we talked about that in last night's video about not really buying into the hype, so to speak, on yesterday's dollar move, and that played out the case. We're getting a very good rotation right now from a sector standpoint. I'll tell you why. It's not just XLK. Today it was not just XLK. Yesterday it mostly was XLK, but not today. And so, and in the sector that joined XLK, which is one of the sectors we want to join XLK to the upside and leading the market, we'll get our trade idea of the day. So let's go ahead and get started. Today is Tuesday, December 3rd, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching here on our blog, check out some of these other things over here on the right, including these old Market Outlook videos. You can see that in all these old videos, we take a look in the Market Outlook live video. We take a look at all of the trades that we've done in these videos. We see whether we should stay in them, how to manage them, whether we should get out. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Hit that like button right there. Again, the more you do that, it helps get our content out to all of our followers on those platforms. So thank you to those who do that day in and day out. Those who don't, you can do right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the the S&P 500 with the market forecast like we always do. As you can see, the intermediate line is in strong upper reversal zone. The near-term line's also up there above the 90th percentile. The momentum line down, again, very small range. It did exceed, by the end of the day, it did exceed yesterday's range, but not by much. And well below the average. The average there at 52 points for the S&P 500. We are still above 6,000. And like I said, short-term sentiment. The momentum line's down, but don't put a whole lot. As long as it's not down to extremes, it's okay for it to be down, because that's what happens when you get small ranges. And small ranges is what happens when you're bullish. Right? You eventually just get smaller and smaller ranges. So as long as the near-term line, the intermediate lines, near-term line's bullish, the intermediate line's above market sentiments, above the 80th percentile, in this case above the 90th, everything's still pretty okay there. Looking at the NASDAQ 100, looking really good today. The intermediate line crossing back above both the market sentiment line and the 80th percentile. Very strong near-term run for a second straight day. The near momentum line down again, smaller range, but this one's not even into bearish territory. It's just below the chart's midpoint. So that's okay. Looking pretty good there. Your Dow Jones Industrial Average, you can see a little weaker. Short-term sentiment is down into bearish territory. After yesterday, you can see we crossed below 60 by getting to 40, and you had the momentum line down to pretty strong levels. Well, now your near-term line is down in the bearish territory itself, but your momentum line bounced. So we have a pretty decent opportunity for a near-term bounce off of this strong bullish posture. We had the oversold levels yesterday, the bullish intermediate confirmation signal, but the near-term line was still relatively high, so it came down today. Now we would expect, now again, it's not very much of a decline, so it might not be a big pop up to the upside, but you would expect that we'll get a pop out of this short-term sentiment tomorrow. based off of that pattern, right? Anything can happen, but just based off that pattern, you would expect to pop tomorrow. And similar here, the momentum line's down, but it's not too extreme. It's in bearish territory. Your near-term line had popped above 40 yesterday and actually got above 50 before popping back down into bearish territory. So again, intermediate confirmation signal. The intermediate line is above 80. The momentum line is below 20. So that's the combination you like to see. In this case, the near-term lines this time is below 40, so it's in bearish levels. So again, based off that pattern, we'd expect a pop tomorrow in both the Dow and the Russell 2000. Again, whether that happens or not remains to be seen. But we would expect that based off those patterns. Neither one of those. The momentum line's not extreme. The Dow Jones, the momentum line's not extreme either. It actually came out of the reversal. It didn't get extreme yesterday. The near-term line's not oversold on the Dow. The near-term line's not oversold on the Russell 2000 either. So those are the kind of things you look for to see, are we going to get a bounce? Because if the red line is below 5 and or if the near-term line is below 20, then the odds start to diminish that we'll get a bounce back up. And again, as soon as tomorrow, right? This would be literally as soon as tomorrow based off of this pattern, right? But we don't have either one of those. So there's a good opportunity. We have a good chance with the intermediate line above market sentiment. Now above market sentiment on all these indexes, right? Because the NASDAQ was the only one that still didn't have the intermediate line above market sentiment. Now it is. And its market sentiment line's rising and is almost back above 8 or almost above 80 for the first time on this run at 79.95. So getting pretty close. Again, with the near-term line and the intermediate line above 80th percentile, you start to, worry a little bit about clusters. So we'll keep our eyes on clusters. If we get a big, generally it takes about an average day in terms of range. If we get bigger than average ranges or even close to average ranges right now, considering how mature the intermediate rally has been and considering how small the volume and the ranges have been lately on regular days, right? It's one thing to have a small range, small volume on a Friday after Thanksgiving where it's only a half a day trading, or even maybe a full day before Thanksgiving where most everybody's gone. This is after Thanksgiving where most everybody's back and still not very much participation here. Let's take a look at the weekly chart now for the S&P 500. Again, pretty decent sized body, higher close, higher Hakinashi close, higher high. PPO is rising already at pretty decently high levels, 92nd percentile. Again, the MACD is above its moving average down here. The Hakinashi differential is above its moving average, but you wouldn't expect it to stay above it for long because we've already had our surge and now we're just converging, right? We've seen this before. This is what it does, right? So we've had our surge off of the low and now we're converging. And so, as I mentioned yesterday, we're probably maybe a week away from getting a transition candle again when the green line crosses back below the purple line, which I expect would happen here next week. Obviously, we have 3 green arrows across the board, 3 green arrows there. Very low volume, as you can see. That's the case for everything, right? Very low volume on the diamonds today. Very low volume on the Qs, and pretty decently, almost average volume on the Russell 2000. So extreme lows on the range, extreme lows on the volume. If you take a look at the 2-line versions, we're still above moving averages. The MACD is still above its moving average, but it's not going to last very long. The histogram is not going to get bigger. This was an anomaly because of the election, but we've already had our surge, as I mentioned before. Sometimes you have a pretty decent secondary surge after when you start this run, but by the time you get to the 3rd and 4th and 5th surges, right, they tend to get really small. And that would be, which means the histogram gets small and short, right? They don't last very long, which means that the MACD, when it crosses above the orange line here, that's when you get a positive histogram. And then when it crosses back below it is when we turn red. And that's, again, what I expect will happen here soon. Probably not by the end of this week, but potentially and definitely by the end of next week, which would fall into the timing for that transition candle on the weekly chart. The DMI is bullish, but not strongly bullish. You can see we're above 30, below 20 on the directional indexes. The ADX has turned higher. It's above 20 now because of that gap. But again, you can see we're not really going up above 30 very much. So I don't expect the ADX to get too high on here because we're not really breaking out strongly. The RSI and the CCI remain at bullish levels. above 60 and above 100, but again, not above 150, which is where that dotted line is. So they're bullish, but not really strongly bullish. We still haven't gotten that surge above 70, which, you know, in this case happened at the end. Over here, it happened at the beginning and then kind of flattened out, kind of converged at the end. We never did get it. You never got it at the beginning, and we haven't been getting it here at the end, despite the divergence here that we see on all these oscillators, including the RSI and the CCI. When you look at the Ichimoku cloud, again, we are back to intermediate strength trend. We never did get a reset, so I don't think we'll get to mature levels, which is generally what happens when you get intermediate strength trends. We tend to make it to mature levels, but that happens after we get resets, and we didn't get a reset here. We were mature, we dropped, we didn't get a reset, and we're back to intermediate strength trend. Again, we've seen this pattern play out exactly the same way before, exactly the same way at the end of 2021. When you look at the Bollinger Bands and the Keltner channels, we are in the upper quartile, which is good, but the bandwidth is dropping rapidly. You'll see that in a second here as well. The momentum is dropping from pretty decently high levels. Remember, we never did really get negative momentum. Very, very brief here. Very, very brief on the negative momentum. The bands look like they're about to cross up above or into the Keltner, maybe another day away from that happening. We're not above the upper Keltner channel, so we don't have that strong momentum push, and like I said, a day, maybe two away from getting red dots, which would potentially lead us. Now it hasn't, right? We've continued these big long intermediate runs, but again, we've been very mature. This one's been going on for a while. At some point in time, you're going to get the red dots leading into the bearish move, especially considering how small that Bollinger bandwidth is getting, which is the same thing with this channel width here. The 4-week channel width is really going to take off tomorrow. So this is going to come over here, and it's going to make this the low point for the 4-week range on the Arun indicator. So you're going to get a big pop on the red line. Probably get around to this level here. Now in the past, when we got that pop, it's been pretty bullish. We've been able to maintain the bullishness on these intermediate runs, and we've already had one on this current intermediate run. In fact, we've had two on this current intermediate run. So here you had one. Over here you only had one. If I were to zoom out so you can see the intermediate runs of the past few years. Here you had one on this intermediate run. Here you only had one on a big long intermediate run there. Sorry, my Siri is going off. Over here you never did have one at all on this intermediate run that you had. You had a convergence where it was more than just a one touch, kind of stayed up there for a while. Over here on this intermediate run, never did have one here. Briefly had one at the very beginning here, but not really. But we had one here, we've had one here, we've had two on this current intermediate rally, and this would be number 3. Tomorrow you'll see a third one. We'll kind of see what we do with it if we continue to push up to new highs. Otherwise, we're going to have a very, very tight range on this. You can see how tight the range was today, which is bringing the ATR down to very low levels. Another day or two of ranges like this, and we're going to be at extremely low levels, which kind of mark the peaks of these last couple intermediate rallies here. So that's something to be aware of and watch for. Volatility is also extremely low. It's not going any much lower because the ranges continue, but you can see we got really close to the 80% mark yesterday. We're getting even closer today. We're at 0.82. Remember, 80% is extreme. You can see the ranges are getting really small in volatility. That happens when you get to these low levels. We're not really getting below 90 because we can't. We want to get as low as we possibly can on this. So we can get get down closer to 80, right? So we'd really like to get and stay below 90 and really solidify this move, but we can't because the VIX is so low. And the VIX is low relative to itself, relative to the VIX 3M. I mentioned it's low relative to itself when you look at it compared to its average values over these different time frames. So, it's low. It's really, really low right now. So it's hard for the VVIX to get going down. And we're converging, right? The ranges are getting much smaller. You can see that you don't really know when you're going to get a pop, but one thing you do know is the ranges tend to compress. And we've gone from a range of in the last 3 weeks of 3.5 points on the VIX to 2.25, and then now to less than 1 point on the range. So we've really kind of starting to compress here. Now we can compress for a few more weeks before we get a pop, but you generally compress before you get a pop. And like I said, it's going to be hard for that VVIX to get going too much lower when the VIX is as extremely low as it currently is right now. So, which is probably the reason why our skew is as high as it is, right? Our skew it remains at very, very high levels, as I've shown you. Well, I can't see you. I'll find it. It's in there somewhere, but the skew is, I think I showed you last night, the skew is at very, very high levels still. All right, now let's take a look at what's driving this price action. Let's go just to today first, and then we'll look at the week so far. So just today, and you can see that commodities are rebounding pretty nicely here after a little bit of a drop. The dollar's been down weekly. Yields have really taken off today. Yields started down a little bit, but then they started to ramp up, and then now, finishing at their highs of the day. So this is what it looks like on the 10-year yield. Let's go to a daily chart. Here, let's do this. The market forecast, and then we'll go TNX eventually. There we go. So you can see after being down, we're closing near the highs of the day today, up about 3 basis points, 4.22% after being below 4.2 yesterday. You also see commodities are really rebounding pretty significantly. So let's take a look at the commodity chart here. Again, they've been in bearish mode. Yesterday, really kind of breaking down, reversing yesterday's breakdown and then some, but still not above any of these major moving averages yet. We're kind of right up to the 17-day, right up to the point of control. So nothing too alarming. Remember, the dollar has been the biggest, most volatile mover. And when you take a look at the dollar's chart, you can see the rebound we had yesterday. And we talked about, remember yesterday in the market outlook, we said don't really buy into that a lot. Like, we're still bearish. I still expect the dollar to be bearish. And that should have a positive impact on commodity prices. Eventually, it should have that. Now, the issue is whether or not there's enough demand for commodities to push it higher. Because commodities and the dollar have kind of, typically they enjoy a negative correlation, right? So if I look at commodities here, and then I bring up the dollar and the correlation chart. So let's bring up the dollar here, and we'll bring up the dollar here as well. Give it a second to load up. Here, let's do this. Here we go. Should be coming up now. There we go. Sorry, I had to do UUP down there because it wasn't working with DXY. But if I were to zoom out now, so let's zoom out and do like a longer term 3-month correlation. Just kind of give you a picture of what's the norm for this. And let's zoom all the way out. So you can see normally it's a pretty negative correlation. That has not been the case since, first of all, in 2022, when both commodities and the dollar both rallied, and that put a lot of pressure on equities to start in our correction. And then you can see it's been pretty positive here lately, but you notice it's starting to move back towards, potentially moving back towards a negative correlation, which, like I said, is more likely the norm for these two asset classes. Which makes sense when most commodities are priced in dollars, right? But again, it's a demand issue for commodities too, and that's the issue with commodities, whether or not we'll continue to have the demand for that. But as of right now, you can see there hasn't been, right? We're below the 200-day moving average. Crude oil is well below. Big jump today, but still well below its 200-day moving average. For that matter, it's also below its 200-week moving average. So technically, according to that definition, it's actually crude oil is in a bear market, right? It's usually in a bear market when it breaks that 200-week and has been below the 8 and 17 weeks this whole time. Now, granted, it looks like we're forming some lows on these oscillators, so there's a chance we might roll up, and the question will be, do we get back above the 200? As you can see, we potentially are moving higher here. We have to get above the 200-day moving average before we can even start to think about getting above the 200-week and getting out of this bear market. So it's kind of hard to be too aggressively bullish on the markets from an economic standpoint, right? Obviously, we can ride momentum and trends as long as they're there. But in terms of like, are we going to get 20 plus returns for the next couple of years, similar to the 90s? If commodities aren't being used, right? If commodities aren't in high in demand to fuel all that economic growth. So that's going to be the kind of the big issue, and kind of surprising for us to be as bullish as we are with commodities in a bear market, according again to the definition of being below and staying below the 200-week moving average. I like that. So that's kind of what's going on in those different asset classes. I mentioned to you before the skew. The skew is now above 170. So the skew remains. And so there's 170 there. Again, that would be like we've been above 170 once before. Over here, 170.55. This one we're at 170.65. So this would be the highest level of the skew that we've ever seen. Right? Well, I take that back. We were here at 171, so pretty darn close but at 170 again, it's like the third time ever we've closed above 170. The average is rising. It's already above 150. This is extreme amount of demand for deep out of the money puts. There's only one reason why there's ever demand for deep out of the money puts, and that the last time we had this much demand for it preceded a correction, and the markets were anticipating it and preparing for it, and eventually went through it. And so that's a little bit of a concern here. Volatility in and of itself, as we showed, is very low, but that skew just remains so high. And the other factor too is we've had some pretty decent breadth. The breadth has been positive, and it's not like we're starting a new move, right? We get a decent amount of breadth when we start a new move. That's not the case right now. We've been on a bullish move, right? We've had bad breadth, but we've been bullish this whole time we've had bad breadth. And now we're back on a bullish run. Again, we've seen this before. We saw this actually right here when all that good breadth, topped us in July of this year before we finally started that intermediate decline there. So the breadth is actually not telling us the best story when you look at again, the number of new highs dropping down back below the average. The average is a pretty high level, so the bar is really is not very strong, right, to get above that 219 level. So the new highs is dropping down. The new lows, you can see, is still pretty low, so we're not close to getting back up above there where we'd have to be too concerned about the new lows, which just makes the new highs and new lows ratio back below its average yesterday. It probably will drop even more below that and potentially below 100 today. So that's something to keep an eye on. On the other side, the number of stocks above the 50-day average, still above 300, still above its average barely. Number of stocks above the 200-day moving average, still also above its average and well above 350, and well above 250 is the mark when we're starting to concern ourselves, and really getting below the 300 level is where you start to worry about like a pullback, right? Enough decline that we're getting a pretty decent pullback. So you can see during the pullbacks we had this year, we never even got to 300 at all. And then 250, remember, we get to that when we're on, correction mode, and this, again, it goes to show just how close we were to correction mode there in the fall of 2023 from a breadth standpoint. But still looking okay, right? We're still positive on the breadth. The money flow is still at bullish levels. But when that all departs, like when this falls back below 60, and especially below 50, and when that McClellan oscillator drops back to being negative again, considering that we've just had this push of positive breadth that is not corresponding to a new intermediate run, suggests that, especially with a renewed move above 500 after been above 1,000 before and still no reset. Again, we've seen this play out before. We saw it play out over here. We'll see it play. We'll potentially could see it play out again. We saw even at the end of 2021 another analog. There's lots of analogs to 2021. We went over one of those in our directional option strategies class today. But very telling analog, in fact, that we're seeing from a technical perspective. But this is one of them, right? Getting back above that 500 level after having been pretty strongly bullish already in this case on this particular intermediate run, and definitely developing some divergences there. When you look at the sector moves today, of course, you can see how strong XLC and XLY have been. And remember, XLY is your Tesla and your Amazon. XLC is your Meta and your Google. And then XLK, of course, is the three big dogs that are dominating the markets right now. But you can see that those two are dominating the markets today, which is a good sign, right? We want to see XLK leading the markets. Again, small ranges, and you can see another down day for utilities and real estate. They had a down day yesterday. They're continuing that, but you can see financials and energy and industrials also pretty far down. In fact, XLK is the only sector that's up on the S&P so far this week, which is not a bad thing. But it goes to show that the breadth is deteriorating. That reopening trade is not a trade, right? The Qs are rebounding relative to IWM. Yes, there is a negative correlation right now, but that's going to be temporary, as it generally is. So if we can continue and break back above all these longer term moving averages with this ratio and get the correlation back up to its normal levels, then we can get the market continuing this intermediate run, but with the right leadership this time, so that it can persist and continue to move into the beginning of 2025. All right, now let's take a look at our trade idea of the day. We'll take a look in the Magnificent 7 space at Meta. Nice good breakout after a little bit of a pullback. I mean, about as flat of a pullback as you can get, but it did produce, the intermediate line down into actually not just in the bearish territory, but also all the way into the lower reversal zone. The market sentiment line still in bullish territory, as the intermediate line has now crossed itself back into bullish territory. Got the bear tag last week. We followed through on that, broke out yesterday, continued that breakout to new all-time highs, or new 52-week highs at least today. Near-term line, strong near-term run up into the upper reversal zone. Like I said, the intermediate line crossing above the 60th percentile, almost above its market sentiment. During this little pullback we had, Meta had some transition candles, and then we finally had one bearish candle a couple weeks ago. Followed that up with a transition and a green arrow, and we followed that up with a good bullish candle, right? Good strong move to the upside there. Obviously, you have 3 green arrows on the stock. Considering the light volume the last couple of days, we had some pretty good volume the last couple of days on this stock. Remember, the volume for like SPY is abysmal, right? So the fact that Meta is at least average is great. Probably means that it's above average in a normal setting. If you look at Meta on its regular moving averages, the 8 and 17 day have also crossed above the 30 now. The MACD and stochastics moving strongly into bullish levels, crossing above the top of the value area on the 1-year chart, right? So there's the top of the value area. It's really bullish to break out of that level. Now we'll see a bunch of bullish breakout patterns here, as you would expect on a stock like this, on a pattern like this. The above 30 on the positive indicator, below 20. The ADX is just getting going, so we might just be starting a trend here. You look at the RSI and the CCI, they're also breaking out above 60 on the RSI, well above 100 on the CCI, up above 200. Looking at the Ichimoku cloud, you can see we broke above the cloud too, and both lines are above the cloud. The rate of change is positive. The cloud is, was green, kind of looked like it was going to go pink, but now it might be turning green again. We haven't even started a week trend yet on this, so it kind of goes to show just how infant stages this is. And then you look at the Bollinger Bands. We're outside the upper band. We're outside the upper Keltner channel as well. The bands themselves are about to close outside the Keltner channels, which means we get a green dot on this change from bullish to bearish and then back to bullish. This will be our first green dot that we've had in a while. So you can see the breakout here. So a good little opportunity for a breakout trade. So what we decided to do was to do a bull put spread, sell that 35 delta out to January, buy one strike away at the 590. Gives me about a 50% return on risk, a little bit more than 50%. We shoot for 30, and we got more than that. So it's pretty volatile. So we're getting more premium than normal for a 35 delta. But we like the volatility here, the opportunity for reward, and we'll take that. And there's our trade for today. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember, subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Tuesday night, everybody. We'll see you all tomorrow.